with, as you cycle from commodity to commodity, you're like, wow, look how much uranium stocks have gone up, but say lithium stocks are cheap, right? Lithium has gone way down and declined, and it's starting to break out. So I've actually been buying some lithium stocks of late. And, I bought some platinum and palladium stuff, ETFs in some individual stocks a few months ago because it was coming out of a pattern. And I think that that's the overall theme that we're going to see here is, I've often talked about it like playing whack-a-mole with your portfolio, where you get these big jump ups because the market gets excited about one element of your portfolio.
Hello everyone and welcome to another edition of Triangle Investor Interviews. I'm your host Lucian Valkovic, and before I announce my guest, just a reminder of a disclaimer. This interview and all my interviews are not a recommendation to buy, sell any shares, products or services. Always do your due diligence and consult with your financial advisor. I'm joined today by Kevin Bambrough, a known name and investment professional with a lot of experience in the natural resource sector and commodity sector. Kevin, delighted to have you finally in my show. You're for the first time here, so warm welcome to you.
Okay, well, thanks very much for having me. It's a great pleasure.
The pleasure is all mine. I want to start with this interview with your new book, The Energetic Investor. I see that the comments are excellent on that piece. In the book, you integrate mind-body wellness with investment strategy. What inspired you to connect biological energy management with the financial decision making? I'm really curious to hear that.
Well, I first started investing in the mid-1990s when I was pretty young. And I read a lot of the classic investment books, including things like, some of those books about the South Sea market bubbles. And it was a special time in the markets when I started investing because we were really at the dawn of the internet age, and this dot-com sort of tech bubble was forming. And I was trying to sort of get my head around the fact that, a lot of times in history, a lot of pivotal times in history, markets get extreme, and there's all these examples of the market staying irrational longer than you can stay solvent, and, the idea of being careful about shorting stuff. But at the same time, you have to be careful about longing speculative bubbles. And so you're trying to look for what are the triggers to, one, if you want to trade that speculative bubble, either staying long during a momentous rise, or trying to find out when it's going to peak and prepare to short it and take advantage of amazing volatility to the downside and then some significant bounces. And so I had gone back and I'd studied everything from, major crashes throughout history, and there's a huge psychological component to it. And especially when you start analyzing and looking at why technical analysis works. There's obviously, you could have this long-term fundamental view that's great, but really digging into technical analysis and realizing that what it is when you analyze charts, you're looking at ways of detecting the behavior of the current herd of investors and how they're viewing the stock and how they're acting on the stock. And the way that, when you see large volume changes, right, like near peak highs and lows, you have to realize this is a pivotal point in the stock's future where the herd, the current investors, the shareholders of that stock are changing hands. So the herd is transforming. And there's going to be typically a different behavior going forward for the stock, either negative or positive, depending on, how the herd is getting recomposed. And you get some, after a long bear market, you see new, very bullish investors coming into a stock. They're going to take it to new highs and they're going to behave in certain ways. And when you start seeing overlaps between sectors, you could start anticipating how to sort of trade and navigate that behavior. And I ended up moving on to work in to self-trade. I was, learning to manage my portfolio sort of as a long-term perspective, but also short-term, like as a day trader. It was a really exciting time back then, and I talk about it in the book when I actually went to an office, a trading office in Toronto, where everybody in the office, there was like hundreds of people, and they'd come and go as people sort of came in and tried their best to become, active traders, swing traders, day traders in the market using a direct access system when they first were being founded. And, over the course of a couple of years there, I just watched so many people come in and blow themselves up. And there was a core group of traders that I tried to work myself, to get to know and learn from, that were successful, that had started early on, just to, some of them a couple of years ahead of me or 6 months ahead of me. And I started to see patterns of what made successful traders successful, as well as reading, continuing to reading books like Market Wizards and that. And I realized that a lot of what doomed certain investors was just it was purely psychological. They just, emotionally would trade, and this tendency to want to take more wins than losses instead of focusing on obtaining cutting your losses small and avoiding big losses. And then they typically would take small gains and not let their profits ride because they're so concerned about managing the numbers of wins. And there's all different ways to go about trading. And I've sort of figured that a lot of that part out over the years and transitioned from the day trading, swing trading to working at a hedge fund. And that's when I started seeing the behavior of clients really come in, where they pull money away usually at the wrong times and, take money out of the funds when they should be buying more, and then want to give you money when the market's expensive based on past performance.
Yeah, human nature. Kevin, how does the energetic investor differ from traditional investment guides, and what feedback have you received from readers on its holistic approach to wealth building?
Well, I think it's very unique. It's a very unique, and there's one other book I've managed to find since publishing that deals a little bit with the biopsychology of investing. But this is, I think, the first book ever written that really gets into, everything from our epigenetics and how we're truly wired, like how we become wired and how we train ourselves to be a more disciplined, logical investor, and also open to sort of sensing the environment and trying to go with the swings if we are seeking, more shorter term trading opportunities. I've had excellent reviews from people who have read the book, as well as some professional reviewers. So I'm really pleased with that. Maybe if you want to ask something else.
The book, Sorry. That's about it. I would like to hear more about the contrarian part of Kevin Bambrough, the commodities, macroeconomic trends, etc. So let's start with, you have been long a contrarian investor with a knack for spotting undervalued sectors. What macroeconomic signals are you seeing today that point to opportunities in commodities, and which ones do you believe are poised for significant growth?
Well, it's funny, I'm actually sort of debating this whole term of how we use the term contrarian investor, because it often, I think people misunderstand exactly what is a contrarian or what a contrarian should be. And you don't want to just be a contrarian for contrarian's sake. You don't want to just go against the trend if the trend is going to be long and powerful, and you could find yourself on the outside not doing too well. So the key, and some of the keys that I go through in the book, and the key to my philosophy for making money over the years was trying to just look for trends and be early. And be as early as possible in what I think are going to become big major trends. And I've actually equated this sometimes to, it's like when you hear a song on the radio for the first time. You might not like it yourself, but you might have a sense, this is going to be very popular with this group of people. Teenagers are going to love this song, and this song is going to do very well with a certain subsector, and it's going to become a number one hit or very popular. And so when I get on to a new theme or a new trend, and I can see it checks a lot of boxes, it's got all the right ingredients in terms of, you can see, this could be a huge market. There's all the time you see when companies used to come into our office to present their portfolio, they always have these hockey stick growth forecasts, right? Everybody says they're going to grow like crazy and have all these profits and why you should buy their stock. But you start saying, okay, well, this actually looks really good on the macro. You start getting this feeling, and your excitement actually grows. It's like a physical reaction. You're like, oh, this is interesting, and look at this market. It's new, it's exciting, and yeah, it seems to be logical. And I can imagine this scenario playing out. And then so I often start with the macro. I have to believe the macro looks good for this. This sector is a growth sector. It's going to be dominant. It's going to, there's real opportunity. And then you start drilling down, well, how should I play it? And let's look for some examples of companies that, have the chance to see real earnings growth and revenue and real profitability and a return on capital. And so when you start digging, then you start seeing all these signs, and you're like, yeah, the management looks good. They've got some patents or something, or they've got some competitive advantage. You then start saying, well, there's enough boxes being checked here, and I feel like I'm early enough, and the valuation is low enough. And if it has that feeling for me, like, well, it's maybe a 10 bagger. And every now and then I come across things like, I'm working on a couple things right now where I'm like, this could be like 100 bagger material, right? This is, it's got that potential. Well, when I check all those boxes, I then get a feeling like, well, I should go fairly heavy in at this point, because I'm not, with all the experience I have, I'm not even sure whether it's going to work out or not. But at least I believe that it looks certain enough that it's worth taking the bet. And typically when I feel that way, and I know the story is going to rise in popularity, people are going to start looking at this as other eyeballs get on it. People are like, wow, it has such great potential. The market's going to reevaluate, and it starts going up by, it might be double or triple over a couple of years. It might be 5 years or 10 years for some of these stories to play out and for you to actually see how the companies deliver. But the stock can still do well just based on the belief that it's going to. And so part of my strategy has always been to sort of load up early and wait for that to play out, and get some profits. And then I either take profits out, so I basically have got a risk-free option on this stock and sector, and I try to keep, and I keep looking for other ones to recycle my capital and grow it. But because I know a sector that is potentially new and emerging, and I try to become an expert in it. And it's funny, you look at some of these sectors, these small little unique opportunities in the market, it really fires my dopamine and gets me excited, because it's something that people don't look at much. And when you start thinking, wow, it's amazing. I was actually working on this small little sector the other day, and I was like, well, how many experts are there really? There's only a handful of companies that actually work in this space, that are public, and there's maybe 100 to 150 private companies in the world that work on this sector. And then the number of analysts, there's actually none. There's no one really, there's no dedicated analyst. So people are sort of looking at it part-time a little bit because there's some overlap as a special situation. And then you're like, wow, there's so few investors. There's so few people looking at this. Is it worth my time to put in, say, a few weeks of work? And I could become an expert. I could literally become one of the leading experts in this sector that might be huge. And then I'm going to follow it. And then that way, when there's a development, when I see news come out and one of these or several of these companies in this new sector are gaining traction, I understand it better than other people, and that's when I either double down and put my investments or let my profits ride, or really take advantage of that momentum.
Yeah, I hear you. What are those sectors? If you care to share, what are some sectors that you...
I'm still doing some work on them and accumulating, but I'm happy to come back on and talk about some of those more. But this, as an example, this would be like, there's a lot of different minor metals. I think you've probably seen, I write about things like molybdenum, and hardly anyone. It's the same thing. No one covers molybdenum. When I started talking about uranium stocks, it was at the low of 2020 when, a lot of the stocks were had been in a 10-year bear market or close to it, 7-year bear market, or whenever, I can't remember what year Fukushima was at this point, but it was a significant bear market since that event. And a lot of the companies were, they were just struggling on the edge of bankruptcy, and there was hardly any, I think almost no dedicated uranium analysts at brokerage firms. And so it creates a real opportunity where when you can see this transformation, this change coming, you step in.
You mentioned uranium. We will stick with uranium for now. I will quote you your post on X. Seems like a deeper pullback is in the cards before we are able to push higher. You said this. You said that after the disappointing disappointing price drop by physical uranium. So my question to you: has anything changed in your uranium thesis?
Well, the long-term thesis is solid. It's rock solid, and it's I believed since the early 2000s when I played the first uranium bull that uranium is going to be a significant part of electrical production going forward, and that it should be pick a number 30-35% of all electrical power should come from uranium based on the economics and the benefits and versus alternative energy, coal, natural gas. It just seems like it should be a large component globally. And there's more and more reasons for that case today than ever. And we're also seeing this, huge demand growth for power, where it's, we're going to need to double the grid because of electric vehicles and AI and, just the global market growth, in emerging markets, demand for power, per capita, power consumption. And so that thesis is locked in, and but there's ebbs and flows. And so I guess it was early April. I wrote a bunch of posts and I did a few interviews with some uranium experts. And I talked about the fact that the stocks looked cheap, the price seemed low. There had been a big decline from the recent, the highs previous. And since that time, we've had many stocks have doubled. The average stock's probably up 50 to 60% in the sector. And yeah, the price of uranium did have this run up. Sprott was able to raise more capital to buy uranium, and I think it surprised a lot of us, self-included, that the price has been slipping back from after nearing 80 in the initial spike. It's slipping back where I thought I saw today the bid ask was 70 and change to 72, and it's thinning out, and people are all starting to go, wow, look at the price has slipped back down, and the Sprott physical ETF is going to run out of capital and stop buying, and where's the price going to settle in at? And I think a lot of the bulls have been surprised by how much physical uranium, Sprott Uranium Participation Corp, or Sprott Physical Uranium Trust has been able to accumulate. And the supply keeps coming, a lot of secondary supply and inventories, and there obviously hasn't been as much of a desperate rush by utilities to build stockpiles. But we know that's going to come in long term. And the question is, does it make sense, despite the bullish announcements from the Trump administration for being massively pro-nuclear over the coming decades, these things take time and there's an ebb and flow. And we've seen stocks double in the last 2 months. So, is there going to be a breather? Risk to reward, looking at the technicals and a lot of volatility in the market. I could see at least a risk-weighted influence in my mind is that we probably slide back a little bit and see a bit of a correction, and then we consolidate and you use some technicals, and then there'll be some type of flag pattern or something, and new demand comes in and off we go again.
Sure.
So I've taken profits because of it, but if you could keep repeating this type of cycle, you have your core positions, and then from time to time you get these opportunities to load up on a sector. And I've done it over the years with, as you cycle from commodity to commodity, you're like, wow, look how much uranium stocks have gone up, but say lithium stocks are cheap, right? Lithium has gone way down and declined, and it's starting to break out. So I've actually been buying some lithium stocks of late, and I bought some platinum and palladium stuff, ETFs. In some individual stocks a few months ago, because it was coming out of a pattern. And I think that that's the overall theme that we're going to see here is, I've often talked about it like playing whack-a-mole with your portfolio, where you get these big jump ups because the market gets excited about one element of your portfolio, and there it experiences a substantial rise. And then, a new influx of investors come, and then, it rolls over and there's profit taking, and you take a little profits. and you put it into something else that you love, that's,
Of course, I
at
have a
low and
similar
looking to
approach,
grow.
Kevin. So I hear you totally. Let's get back in 2006, 2007. That is when I first entered the uranium market. Back then, you recommended uranium stocks like Laramide. Strathmore was active in those days for their quality assets and management. So, what uranium stocks or projects are you excited about today, and what criteria do you use to evaluate them?
I think that criteria is similar. I mean, I recommended a lot of stocks back in the early 2000s. I mean, I was a big investor in Paladin from 8, 9 cents. I started buying the company, and we exited that at like $6 on its way to 9. And John Borshoff, has done a great job again this cycle. The market cap's ballooned, and but he's delivered on building up assets again. I mean, the guy knows how to acquire property and affordably add reserves. I mean, it's cheap drilling in jurisdictions that are permittable. Obviously, I'm close with Bill Sheriff, and he's done a great job with Encore preparing for this bull market again. I was a big investor in Energy Metals from its right when it first became public, right to when it was taken out. We actually could have married that company with Strathmore prior to it ultimately getting taken out, but they refused to do the merger. I mean, that's one of the problems I have with some management teams, is it seems like they want to hang around and be CEO and keep replenishing their options and their pay. And they, when you try to merge companies together or see them getting taken out, there's a big conflict of interest for a lot of the management teams. They don't necessarily want to just take an exit package, and they often think that their company's worth way more, and they don't see the top coming sometimes, right? Hey, did you want me to talk about more names or just the...
Yeah, definitely. You can expand on the names as much as you want.
Well, I'm actually going to be a director of a company soon that's coming out. I'm not sure actually if I'm supposed to talk about that one yet, but there is some companies that are emerging. Obviously, there's a real advantage, I think, and we're seeing that right now in being involved in it with U.S. assets because of the Trump administration sort of leaning towards whether it's copper tariffs or export or import restrictions. It seems like they're happy to drive up prices somewhat domestically to encourage domestic production, and it's creating like a bifurcated market where some countries aren't going to get necessarily the highest prices for some of the commodities because of tariffs or whatever. And there's workarounds that all balance out in the end. But I think that looking at some assets within the USA makes sense to a certain degree because they are so short production and they have great demand. And I actually equate this. I also am negative on the US dollar. And back in the late 1990s, I made very large investments in gold and silver companies in South Africa because the rand was collapsing and there was a lot of negative sentiment around South African stocks. But I believed that it was a good bet because the rand was falling, margins were going to increase dramatically for South African producers. And so I decided to take a strategy of owning in putting up some significant risk into some South African names, thinking that they were by far going to prove to be the cheapest because of a falling rand and the profitability that they would have. But at the same time, if there was real problems there, they were so significant to world production that the other stocks I owned, the would-be miners with higher costs, were going to explode in price if there was problems in South Africa. And as it turned out, the gold bull market of the early 2000s was so good that you made a lot of money on no matter what gold stock you bought, as long as it was a legitimate contender to be a producer.
Yeah, Kevin, you warned about speculative bubbles in uranium stocks and the risk of overvalued juniors. How do you advise investors to navigate sector hype while still capitalizing on the bull market?
Well, that's always a difficult, it's a difficult thing to predict the time. I often say it's a lot easier to predict bottoms than tops because you never know how far a mania is going to take stocks. And I remember, near the 2000 peak, it became obvious to me, when I was doing the math, that you don't really need, back then, you didn't really need a price to sustain much over $100 a pound because it was such a strong incentive to fund a lot of mines and fund production. And there's, just like there's no cure for low prices, high prices spur investment, whether it's, you see when oil and gas prices spiked in, 2007, 2008, huge investment, record investment into the oil and gas sector. And then guess what happens? Yeah, big supply response, prices collapse. And so, over the longer term, you try to look for, well, when's the big dollar is going to pour into a sector and when is there going to be a significant supply response that we need to be worried about? And you want to sort of get out in front of that more than anything. As far as speculative nature of juniors, I mean, the reality is, I think it's something like, less than 1 in 10,000 mines, right? Like, and I say mines, like exploration properties become a mine, okay? Like these companies are often, they're called shitcos for a reason, okay? And we used to always joke. I mean, John Embry and Eric Sprott, two of my mentors back in the Sprott Asset Management days, used to always joke like that, the definition of a mine was a hole in the ground with a liar on top of it. And that's the reality. I mean, you have to understand that when the sector turns, you need to get the hell out of pretty much everything. So I think the macro is most important and trying to time that in the sentiment and the capital flow. But then when you drill down, I sort of take a basket approach usually. And I say, although I don't really care for some of the big companies sometimes in a sector, and I think that they're not positioned as they should be to take advantage of rising prices, and that could have been, in the early 2000s, Barrick Gold was constantly hedged and they missed out on billions of profits, right, for shareholders. And Newmont was the bigger cap go-to stock. So I was, much more favorable to Newmont. At the start of this cycle, I was hoping that Cameco would engage in a lot of contracting, and they were very aggressive with contracting in the right up into the mid 40s and capping their upside. They made some great moves to purchase Westinghouse so that at least on the surface, they appear like they're this large, diversified go-to stock that, everyone from Cathie Woods to, the big investors and hedge funds are like, well, what could I buy in this sector? Well, Cameco's in a safe jurisdiction. It's a big market cap company. Let's put money in it. And that's why we've seen it run to new highs. But longer term, are the earnings actually going to come through? I mean, that's really hard to predict. It's really hard to predict when you try to dig in and go, well, how much money are they going to make, with the Westinghouse division contracting and engaged in building reactors, and how much are they going to make from mining uranium, and what is the all-in replacement cost when you actually look at the depletion and the rising costs and whatever. It's a tough business to make money in.
Yeah, very good point. Kevin, if you agree, I would give you 5 uranium companies, 5 developers. And if you can give me your opinion on them, some pros, some cons, if you agree. I would like to start with Denison Mines.
Denison's one that it's a high beta stock. I've traded it since the 2000s. And I typically... although often I think it's a little expensive, I just know it's a high volume stock, and there's potential there because they have the mill, and there's a lot of opportunity there that they could potentially take advantage of partnerships with other companies and their relationship and their assets and whatnot. But I mean, I'm not, just to be clear, it's really, really tough to try to, after some of the rallies that we see, to say that these stocks are cheap based on current uranium prices. You have to really look forward and say, well, what could the price go to, and where is this sector going to go?
Understood. Yeah. The next one is NextGen.
Yeah, well, NextGen is often touted as probably the most significant mine in the world for uranium. It could be, it's slated to be probably the most important asset going forward. And there's often speculation that it's just a matter of time, like Cameco or somebody big is going to take it out because it makes sense. And I often wonder, if you look at the past cycles, whether it was the 70s bull market in uranium, or even the last bull market, but especially the first real bull market, oil and gas companies, wanted to become energy companies and looked to acquire uranium production. And who knows, diversified mining companies like the big boys, like the BHPs of the world, they might decide to step in and say, look, this is a sector we want to be in long term, and it makes sense to take something like this out. And so I think it's ultimately a takeout candidate. I think that, and I have been bearish on its timeline that it's been forecasting for. It just seems like it just keeps getting pushed off, and who knows how long it'll actually take to get built, and all these things. That's the one reason why you get so bullish, or I get so bullish and excited about the commodity markets in general, is it doesn't matter what the commodity is. Timelines to bring on production and the costs associated with bringing on production always seem to take longer and cost more than everybody thinks, especially at the onset of a bull market, which means prices are going to rise way more. And that's an opportunity to buy quality assets and wait. But also, there's going to be this ebb and flow of disappointment. So I like to actually see that a company's put out some disappointing news sometimes and then saying, yeah, well, let's now it's actually an opportunity to buy it.
Yeah, agreed, definitely. Kevin, what's your take on UEC, Uranium Energy Corp?
Well, it's funny, the U.S. producers were ones that I went heavy in right in 2000, knowing that they were going to probably go bonkers in terms of market cap and price and valuation because of sort of a scarcity of domestic companies and the fact that they're sort of they have the home field advantage for marketing to the biggest investment market in the world, right? Being right there at home and going on CNBC and getting interviewed and accessing, being able to do the tour regularly to the different brokerage firms and fund companies and clients and stuff. That said, they get expensive, but they stay expensive. I mean, last bull market, I got shaken out of those names and I took profits too early, and then they went on and doubled. But, and the same time, the same things happened this cycle where, I took profits early on some of these names, thinking that the valuations were high, and they continue to stay high, and they probably will continue to stay high. But I'll look to, again, when it comes to these names, the more liquid names like that, I'm more of a trader. And I go heavy into the ETFs at times because of the liquidity. Like if you want to really move money in and out of a sector and you're not concerned about capital gains, like you're trading in a 401k, or you're investing in your 401k, or you're investing in an RRSP or other tax sheltered structure, and you want to deploy a lot of money quickly and take advantage of short-term moves, I'm sort of more ETFs.
Sure. What about Cameco? Do you believe that Cameco is now too expensive? It passed $100.
Yeah, I mean, I think I said early on, despite a lot of people quoting me on my, calling me a bear on Cameco, once they did the Westinghouse transaction, I said that I believe that its market cap will ultimately go to, a very high number. It's the only real sort of go-to stock. People aren't going to, most people are cautious for good reason from paying up for Kazatomprom. There's just too much political instability there. And, you saw what happened a couple of years ago with, it was almost like a coup, I guess, wasn't it? I don't know how you describe that exactly, but Russia had to step in to get order. And, there's a lot of talk about increased taxation there and, increased wages and, it's a high risk environment. And so Cameco is one of the few go-tos. And, yeah, I think it's going to go to $200 a share. I said that early on, and I still believe it.
Okay.
That said, that's not my style. I don't own Cameco right now, other than through ETFs. And unfortunately, sometimes it's a little too large a position in an ETF for me. I often say don't try to get the last double out of stocks, right? And I think that it could go up to $200. It could go up by more, but I still don't think it has the torque that some other names might at the right time.
Sure. We covered four.
And
I
by the
believe.
way, I'm cautious about talking too much about junior names. I know because I am an active trader, I just don't want to ever be accused of like this whole pump and dump type thing, right? So I'm,
Okay, is there any junior company that you really like that has a strong management,
I'll
great
say
project?
this. I think in the coming weeks, you're going to see that I've gone on the board of a junior company and I own a stake in it and I plan on buying more in the market. And that'll be one that I will, it's one that I'm sticking with, right? Because I'm willing to go on the board of it. So that'll be answered and you can,
We will
look for
stay
that.
tuned. Definitely, I look forward to see which
But
company
I'll
is
say,
that.
generally speaking, the go-to names a lot of the time, I mean, it's tough, like you sit there and you look at what happened to Paladin when it disappointed with production. And I expect these things to happen. So it's like, it has, stocks like Paladin, I was a huge investor in once I saw that the uranium bull market was intact. Again, this cycle, I loaded up on it. I, coincidentally, started buying at 8-9 cents and bought it all the way up to 12-13 cents and saw it had this fantastic run to $1 a share and beyond. But I was taking profits when it joined the ASX 300. And then I became concerned again that they're going to have disappointments. They're going to have cost overruns. They're going to start up a little slow. Are they overcontracted or not? It happens every cycle in every commodity to somebody, right? And so,
Kevin, yeah.
so there's a correction, and then I look at buying again, right? And then of course I want to take profits again after this dramatic rise. But there's companies like Lotus that have former Paladin assets. And yeah, I've been investing in that stock. I took advantage of weakness lately. I've taken some profits again because I'm concerned again, is there going to be a disappointment or not? Is it, if there is or isn't, if there is a disappointment, I'll be loading up and taking advantage of any pullback it has because I think it's got quality assets. And then there's other juniors, especially in Australia. I think the basket of junior companies that are Australia listed are cheap relative to a lot of the North American names right now.
They are. I agree with that. A lot of ASX stocks, uranium stocks, are undervalued compared to TSX, and that has been the case for the last, I would dare to say, a year or even more.
And I'm, by the way, I don't often talk about it, but I've been looking at things like, like whether it's a copper or nickel or coal or whatever. Like I'm shopping on the ASX. I've traded ASX stocks since the early 2000s, and I've continually found great value there. And then oftentimes one of the great things about a lot of my former investments in ASX stocks is they get bought out by Chinese conglomerates, It's a very attractive market for takeovers,
Yeah, I know. Yeah. Kevin, final question. You previously discussed the diminishing trust in fiat currencies and the potential for commodity-backed monetary systems. Do you still see the future for an energy-based currency, and how would that reshape commodity investing?
Well, I think the future that I try to describe, and I'm actually working on doing another book right now that's going to be basically on resource cycle, right? Cycles in general, economic cycles, and resources in particular, because it's something I love right now. And it goes into the whole fiat currency dilemma. And, I like to focus on real assets and real prices, and rather than just trying to get nominal gains. And I think when I sort of look at the dynamic and what's happened over the years, it's because of the evolution of the dollar itself to become the world reserve currency, originally backed by gold, and then backed by gold only for central banks, and then Nixon broke that. And there's just been this evolution of a loss of faith or trust in how these dollars are going to be created. And moving into the 2000 era, there's been another, what I think is a major loss of trust. They've demonstrated a willingness to bail out their own banking sector, their own companies, their own citizens, whether it's, the mortgage crisis or the banking crisis, you name it, as they, or COVID even, right? They just print trillions. The Treasury just issues bonds. The government has no fiscal responsibility whatsoever. And they just issue Treasury bonds. The Fed will buy them. And this whole concept of, like, everyone talks about the debt being, in the high $30 trillion level. And I'm like, chop 5 off that, because they've already monetized it. And when you own bonds that, you're paying interest to yourself, it's not really debt anymore. And I think they're going to continue that. And so one thing that I've always argued, and I've given numerous presentations and speeches over the years at different commodity conferences and to Sprott clients back in my Sprott days, was trying to explain the stupidity of foreign central banks to fund the trade deficit in the first place. Like why, it makes sense to certain countries. Like I remember actually meeting with I met with the head of MPS. And that's the national, NPS, National Pension Service of Korea. At the time, they were the 3rd largest pension fund in the world. And I sort of had discussions with them. And I did the same with CITIC Bank, and which is basically in CITIC, the broker. They are basically the Chinese government financial arm, right? And you try to figure out, why do you accumulate so many dollars? And it was clear to me that the Chinese were accumulating so many T-bills because they liked the influence that it would have, and that it would help facilitate the transfer of technology, that they were a friend to the USA, they're buying their bonds, they're reinvesting in US stocks and companies. And so it's this cozy relationship. Come set up, you want to do business in China, come bring your technology, set up factories. And, ultimately they ended up, I guess I should just say, they basically stole all this technology. And they just set up shops right next door using the same, a lot of the same technology, and just rebranding. It's amazing how much has been ripped off. And then for Korea, I think there was sort of an understanding that they want the US's support versus North Korea and military support and influence there. And so they continue to fund the trade deficit. But for most countries, it just doesn't make sense, especially when you see the amount of printing that's going on, and the fact that these dollars are just getting created out of thin air. And, of late, the Trump administration has been talking about who's ripping off who, like accusing the world of ripping them off. And I'm always of the focus of, well, look, we're not actually, if anyone's ripping off the US, it's US corporations, right? Because they're taking advantage of cheap labor in other countries. And yes, those countries are making some profits on manufacturing these products, but then they get ultimately taken to the USA. There's huge dollars spent on marketing. There's huge dollars spent, that go to corporate profits and executive compensation. And, the goods that cost, say, 10 cents on the dollar versus retail price, you're marking them up by tenfold and selling them to the U.S. And if you look at the food chain of who actually is making the bulk of the money off of the outsourcing of manufacturing or producing goods in other countries, it's U.S. corporations are making the bulk of the gains and have been benefiting from it. And when you see that what profits actually do flow to these other countries, they recycle them back into U.S. bonds and the U.S. stock market, which creates almost like this self-fulfilling Ponzi scheme type situation where, foreign governments buy the U.S. bonds and make the currency look strong, which perpetuates their ability to continue to produce goods abroad, bring them home, and then afford. If a government can afford to run massive deficits and trickle down capital to its citizens because it is the reserve currency of the world, and then is allowed to go and spend it abroad, it looks like they're rich. But it's only because all these other countries are enabling them by recycling those dollars back into the stocks and back into the bonds. And
That's a good point.
As that stops, it's going to be disastrous. That's when we're going to see runaway inflation. And all of a sudden, the American consumer, which has been the bedrock of the American economy, might get a real, imagine if the American consumer stops consuming, the whole profitability matrix of these companies comes into question.
Yeah, the music stops. Agreed.
And valuation, right?
Yeah. Kevin, how can people reach out to you? Where can they find your book, buy your book?
Yeah, the Energetic Investor book's available on all the major platforms. You can also go to energeticmedia.com and find me on X. I'm at Bambrough Kevin. You can follow me. I read a lot of articles on finance, but also this, what I call the three pillars of mind, body, and finance, because they all interconnect.
Go and follow Kevin. Kevin, thank you very much for this interview. I really enjoyed it.
Hey, thanks very much for having me.